Morning, I'm Taylor Wesson and I'll be taking you through Tigerbrands year-end results. Let's take a look at what we will be covering today. We'll start off with the nature of business, followed by the recommendation, the financial review, divisional review, company guidance, and end off with portfolio guidance. Moving on to the nature of business. Tigerbrands is a top 40 JSE listed company whose footprint extends across the African continent and beyond. It's one of the largest manufacturers and marketers of fast-moving consumer good products in Southern Africa. Now moving on to the recommendation. We feel the share is fairly valued, trading at a forward PE of 17.2 times, slightly ahead of its long-term average and local peers, but still below its global peers. Tigerbrands is a high-quality food producer with a high ROE, a strong balance sheet, and good cash generation. The group has an attractive portfolio of leading brands with a good spread across both market segments and price points, and continues to display its resilience as a defensive play. Volume growth is expected to remain muted given subdued consumer spending in a constrained economic environment, resulting in increased competition for market share. Competition remains fierce, increasing the reliance on high levels of marketing and product innovation and to maintain market share. We expect lower volumes to be offset by margin expansion, given the group's conscious decision to protect margins in this environment. Currency movements impact export results and improve its competitiveness against imported products, although the push from currency movements will likely outweigh this effect. Now moving on to the financial review. Revenue rose by 2% to 31.3 billion, with domestic revenue up 4%. Increased competition and constrained consumer spending weighed on volumes, with volumes down 3%. Gross profit increased by 7% to 10.4 billion, resulting in a higher gross margin of 33.4%. Adjusted operating profit rose 10% to 4.6 billion, with the adjusted operating margin increasing to 14.5% due to improved pricing strategies, good procurement, and well-contained costs. Ultimately, headline earnings and diluted HEPS from continuing operations came in 2% higher at 3.5 billion and 2,112 cents respectively. The gross final dividend was maintained at 702 cents per share, which when combined with the interim dividend of 378 cents per share, brought the full-year dividend up by 1% to 1,080 cents. Cash generation was strong, supported by working capital improvements. Now moving on to the divisional review. Grains. This is the group's largest division and contributed 42.5% to revenue and 51% to operating profit. Revenue increased by 5% to 13.3 billion, supported by a 1% increase in volumes and higher prices. Operating profit grew by 18% to 2.4 billion, resulting in a higher operating margin of 17.7%. Milling and baking operating profit grew by 16.5% to 1.9 billion, supported by higher volumes which was somewhat offset by price deflation in maize and sorghum in the second half of the year. The operating margin increased to 19.5%. The wheat-to-bread sorghum and maize-based breakfast offerings delivered a strong performance. Other grains grew operating profit by 26% to 502 million, driven by strong growth in breakfast and rice. The operating margin increased to 13.3%. Higher profits from Jungle Oats were driven by improved mix. Rice benefited from volume growth and favorable mix and procurement position. Pasta volumes were impacted by higher prices. Now moving on to consumer brands. This division contributed 36% to revenue and 27% to operating profit. Revenue rose slightly by 1% to 11.1 billion, impacted by a 9% drop in volumes. Operating profit increased by 7% to 1.3 billion, resulting in the operating margin expanding 60 basis points to 11.5%. Groceries operating profit grew by 26% to 588 million, driven by improved pricing and productivity. The operating margin expanded 190 basis points to 11.8%. Snacks and treats volumes were impacted by industrial action and SKU rationalization. Operating profit rose 2% to 323 million, despite lower volumes. Operating margin improved 100 basis points to 15%. Beverage operating profit fell by 8%, impacted by a poor performance in the first half of the year due to industrial action and water and electricity restrictions. Beverages experienced an improved second half of the year. The operating margin expanded by 10 basis points to 12%. Oros ready-to-drink continued to gain traction. Value-added meat product volumes were impacted by higher prices and increased competition. Operating profit fell by 34% due to lower volumes and higher raw material costs. The operating margin fell from 7.1% to 4.6%. Now moving on to Home, Personal Care and Baby. This division contributed 8.5% to revenue and 13% to operating profit. Revenue was up by 9% to 2.7 billion, with volumes up 2%. Operating profit increased by 17% to 623 million, resulting in a higher operating margin of 23.5%. Personal care was impacted by the discretionary nature of products. Operating profit rose 3% to 138.6 million, resulting in a lower operating margin of 20.3%. Home care recorded robust growth, with operating profit up 47% to 276 million. The pest category continues to outperform. The operating margin increased from 21.1% to 25.6%. Baby care operating profit declined by 2% to 207.7 million, with volumes in jarred baby food coming under pressure, while pouches grew volumes. The operating margin expanded by 40 basis points to 15.6%. Now moving on to international and exports. This division contributed 13% to turnover and 9% to operating profit. Turnover declined by 5% to 4.2 billion, impacted by a 3% decline in volumes. Operating profit fell by 20% to 399 million, resulting in a lower operating margin of 9.5%. Exports operating profit grew by 10.5% to 272.9 million, benefiting from normalized sales in Mozambique. The operating margin improved by 40 basis points to 15.6%. Trading improved in the second half of the year on the back of improved distribution and product availability. Central Africa volumes were up by 9%, driven by new products introduced. Operating profit declined by 2%, or up 9% on a constant currency basis, to 147.2 million. The operating margin expanded by 90 basis points to 17.9%. West Africa was impacted by higher prices to offset higher raw material costs. The business was also impacted by lower consumer demand. In constant currency, a higher operating loss was reported. However, when translated, the operating loss was lower. An operating loss of 34.5 million was reported. Now moving on to company prospects. Management expect the trading environment to remain tough, with growth levels expected to remain low and no material improvement in volumes expected. The group has been successful in enhancing margins and will focus on maintaining market share through investment in power brands and innovation. Significant progress has been made in improving the working capital cycle. The group will continue to focus on cutting costs and improving efficiencies through its zero-based budgeting philosophy. Now moving on to the portfolio guidance. Tigerbrands has a weighting of 1.18% in the capped SWIX, and we would recommend a portfolio guidance of up to 1.41%. Before we end off, please take note of the following disclaimer. Thank you. That concludes my webinar. Should you wish to ask any questions, please type them in the chat box, and should you wish to place a trade, please feel free to contact our trading desk.